Ahoy there, traders. How are we doing? Hello, hello, hello. Hello, Randall. Hello, Bal. Hello, Fitzroy, Perry. Tom. Hello, Tom. This your first time, Tom? I don't recall seeing your name before. Hello, Vito. Hello, Wallace. Hello, hello, hello. Right, okay, I'm just pushing a few buttons in the background and we will get rocking and a rolling. So let's dive in. Not too much preamble today. One or two new faces still coming into the session. I did take last week off, long weekend, much needed rest and relaxation. But nonetheless, so welcome one, welcome all, and we're live. Ahoy there. So today's agenda, as usual, we're going to look at the charts. We're going to spend about 60 minutes talking about the markets. First time, Tom, obviously, welcome. Hopefully sit back, enjoy the ride, and maybe we'll see you next time if you like it. But anyway, we're going to spend about an hour together. I am a talker. We may go over. We're going to spend 2 minutes just introducing myself. We're going to look at the markets, look for swing trading setups. I'm predominantly a trend trader, so that is what we will focus on. So what I aim to do is dispel the notion of the BTFD nonsense. It doesn't mean what you think it means, as we keep saying. We need to add one little criteria, which is buy the dip in the context of a trend. If there's no trends, there's no dip to buy. That's the bit that people, and certainly the textbooks, tend to leave out. So I'm going to show you how I do it. It's really simple. It's rule-based. It's methodical. More importantly, it's repeatable, which means that you can walk away today and be able to do it. As always, the way to get most out of the session is to interact, comment, like, share, ask questions. If it's appropriate, I'll answer it in the moment, or I'll save it till the end. So again, if you've got a question, pop a comment. So we've got a warning. There are no diamond hands here today. We're not doing silly things to diamond hand or paper fists or zircon nipples or whatever the fuck that they're talking about on the meme stock thing. We're not playing that game. I follow rules. It's taken me 28 years to get here, and I'm a product of my own system. Is the bottom line on this. It means that I don't flick through chart after chart after chart like a mindless zombie, hopping from indicator to indicator, looking at down 3, GAN 3, Elliott wave theory, all the keyword there's theory. I'm looking for facts. I'm looking for actual things. And so that's what I'm against. It does mean that what we do is boring, absolutely boring. The rules that we have, they're there for a reason. They work. And I think I would rather be bored and make money, because that's what the rules and the system that I'm going to show you does. And again, it does make money. Where's my next slide? Oh, there we go. So it makes money. There's some of my results. Broker statements are on the charts. Again, some recent results. Again, broker statements attached at the top there. I know it works, and I've got the data to prove it is ultimately what we're getting onto here. And again, I'm going to show you some of these things. Again, it's data-driven results. I'm moving almost completely away from discretion. I'm very good at it. I spent 12 years analyzing charts exclusively on lower time frames, essentially day trading. Again, I am good at it. I can do it with the best of them, but I want to spend as little time as possible at the computer and still get all the results as if I was there. So that's where I'm at today. That's what I'm going to show you. And again, the reason why we're using rules is, and again, just final word of warning, if you're tempted to change the rules, don't. It's not broken. It doesn't need fixing. And the rules that I'm going to show you in a moment are, again, it's not broke. Don't fix it. So just do it. I'm going to prove that it works, so you shouldn't have to get under the hood and tinker. So if it is your first time, I know it's one or two people's first time, just casting my eyes down the list. Wallace, you've got your hand raised. You've got a question. If I don't see it in the chat box, again, Adrian. Chandu, hello. Hello, Zeke, Fitz, Ian, hello, welcome back. Suli, hello. And again, it looks like it's just two newbies today. I think there's a couple of people popping in and out. But nonetheless, I'm just a regular guy, is the bottom line here. I didn't have anyone to ask when I first started. That was just the way it was. It was in the mid-90s. I didn't know that there was other people doing it. I thought I was like most people. You think you're the only one. You're not alone. Is the bottom line. But I made every mistake that you could make. I learned the hard way. It was definitely the hard way. But it made me the trader that I am today. I learned fast. I made mistakes quick. I learned from them just as quick. I like cake, coffee, occasionally ice cream, good book, long walks. I've got a weird ass crazy thing for we all got a crazy thing. With me, it's flamingos. I don't know why. We've all got that crazy obsession with silly things, but that's mine. Anyway, I've been trading since the 90s, as I mentioned, and since about 2001, 2002, somewhere around, I've been helping good traders become great traders, and that's what I intend to do today. I'm not a Wall Street guru. I've never worked in the industry. I'm not intending to either. And the legal beagle thing is that past performance is no guarantee of future performance. What I can do is show you that the markets do rhyme and rhythm together with each other. So the only thing that I can show you legally is that my practical in the trenches experience of the last 28 or so years of actually doing it rather than just talking about it and theorizing it. The strategy that I use is, as I was alluding to a moment ago, systematized, it's rule-based. Again, you don't have to take my word for it. I've got quite literally hundreds, if not thousands of students over the years who have said that they're getting their own measure of success, their own version of the production line results, because it's repeatable. It is a repeatable process. I've got a folder quite literally just full of people saying thank you. So, thank you back essentially for, you've put all the hard work in to learn the system. And it's just wonderful to see that you're getting your measure of success. I refer to what I do as a production line because it is just that. It's a proven system that is a production line. And I just want to move things through that production line to eventually either placing the trade or managing the trade. So today you're going to see my number one money-making pattern. It's one of 6. It's a simple rule-based system. It's proven profitable, repeatable. I'll demonstrate that to you in a moment. It should take about 20 to 30 minutes a day, a few times a week. And practically, I'm a little bit faster at it because obviously I'm the product of my own system. When you're learning this, it might take you 45 minutes to an hour, 2 or 3 times a week, or maybe every day. I don't know how fast you learn things, but it might take you a little bit longer. But eventually, it can take as little as 5 minutes if there's very little to do, but it should take you about 20 to 30 minutes, 2 or 3 times a week. And the last sort of 6 weeks or so, I've been doing a lot of research. I've probably checked in and do the actual act of trading about 10 minutes twice a week. So it is possible to get the results without having to flick through chart after chart after chart like a mindless zombie, as I lovingly say every time. I think I just wanted to say it again because I can get my favorite slide on the board. Nonetheless, what it allows me to do, as I mentioned just a moment ago, I get to do other things. One of the things that I like doing at the moment is the tickers of life. We're going to focus on the boss ticker, the business of stocks. I like to try and have my trading activities around my life these days. I think I don't really believe in work-life balance, but I think that most people have the work-life imbalance perfectly aligned. So I want my business activity, the business of stock markets in this case, I want it to support other things. I want to go and do stuff with my life. I don't want to spend time at the computer. I try and practice what I preach wherever possible. I get to party. I get to go walking. I get to go hiking. I get to go and see randomly ridiculous old houses, which is my thing. Again, I'm a bit quirky with the 80s, recent parties that I went to. I get to have fun. Again, I don't know what your thing is, but that's what the market has given me over the last 20 plus years since I've been doing this full time. So what I'm trying to get to really is what's your reason why? I want to enjoy life. I want to be outside. I want to be outdoors. Usually I'm hiking in nature somewhere, as I just showed you. But what's your reason? Why are you doing this? Is it financial peace? Is it better life? Is it more time freedom? Is it an extra income stream? Or maybe you want to stroke your ego a little bit. Maybe you want to become a world-class trader. I don't know what your reason is, but it shouldn't be all time consuming. And when you figure that out, you get to set yourself on a path to success. And although I actually put financial peace there, notice that I've not said money. Money is a byproduct of process. So when you learn a process, whether it's the trading process, my process, a business process, Every successful act has a systematic approach to it. And we could be talking about sports. There's a process to becoming better at that as well. There's a system that makes it better, or for you to be better at it. And again, what I'm trying to get to is that trading is no different. Now, if you want to go faster, again, I'm not shy about it. You can be invited to work with me. It's not for everyone. It is by application only. I'm very selective with who I work with. Regardless of experience, you should be able to plug in. Basically, I have an application. If you're an arsehole and we're a personality clash, then that's all I'm really filtering out, because I am completely in your corner when we work together. My job is to make you a better trader. And if there's a personality clash, it's not going to work. So that's the only reason why there's an application process. I've worked with people that, unfortunately, we don't like each other, and it's not pleasant. It's not pleasant for either of us. So again, I want to do things that I enjoy. If it sounds like you might be a right fit, you like the sound of my voice. If you don't like the sound of my voice, then maybe you're in the wrong place. I don't know. But if you want to go faster, you can work with me. I have a group mentorship, and I occasionally do one-on-ones, and doing less and less of them at the moment, because again, I value my time more and the freedom that I have at the moment. The base process is we focus on the minds, we focus on the strategy. That's what we're going to focus on today, and trading reviews. We want to constantly review, assess, so that we can become better traders. And where are we? I've got a slide. I think that's it. Right, let's jump on to the main event. Let's go and look at the charts. Absolutely, Randall. Thank you for your kind words. Randall's just said he means what well, there we go. I think it's a private message, that, Randall. But yes, I do mean what I say, and I do take it very seriously. Thank you very much. Thank you for your kind words. So, looking at the charts, again, there's a few new people. Again, I can see you're all logging in. There's one or two old people. Hello, Terry. I haven't seen you for a while. But I think everyone who's coming is here now. Excellent. So my chart setup, I'm a one time frame person. I do not believe in multi-time frame analysis, top-down approach, bottom-up approach, sideways approach, big titties approach. I don't care. One time frame, it works. You don't have to go daily, weekly, monthly, weekly, daily, 60-minute charts. You don't have to do that bullshit, even when I'm day trading. And I do day trade from time to time. It's very infrequent. But when I was really actively day trading, it's one time frame. You don't need to do the multiple time frame approach. It's a waste of time, and all it's going to do is suck your life out of you. And one of the reasons that you might want to avoid multiple time frame analysis is they're always going to be in conflict. The daily chart's going to suggest one thing. The weekly chart's going to suggest another. The 60-minute chart's going to suggest something else. The 5-minute chart's going to suggest something else. They're all in conflict with each other. And as a new trader, even as an experienced trader, it does create confusion, because they're out of kilter with each other. So let's just make it simple. Press the easy button wherever possible. I want to one time frame it. There are, move my cup of tea out the way because I nearly knocked it over. There's 3 lines on my chart. There's the 200-period moving average, there's the 50-period moving average, and there's the 20-period moving average. There is nothing magical about the moving averages. There's nothing magical about any indicator. There's not one single blue line that makes it all work. Mine are green, I know what I'm saying, but you get what I'm saying. There's not one magic bullet that makes trading work. The tools that we have on the charts, they allow you a filter, a lens to look at the markets. And when you have a lens, a filter to look through the markets, it allows you to start to apply rules, to start to apply structure to what we're doing. In fact, let me just go to, where's the chart? Let's do Jeffries. There we go. So what it allows you to do is to, in fact, that's the wrong one. Bear with me. I thought I was being clever, but clearly I wasn't. So there we go. That's the one I wanted. So what tools, what indicators allow you to do is to have a structure to evaluate the markets. That's all they do. So there's nothing clever, there's nothing magical, there's nothing mystical about them. Then there's no voodoo involved. It's just structure. And when you learn the rules, so for example, the rules are when the 50 period is above the 200, we're going to call that a crossover. When the 50 is above the 200, then we're going to call that a bullish state. And it's going to be a mechanical assessment. Again, I'm not necessarily married to the crossover points, but it just allows me a filter to say, you know what, when price is above the 200 and the average prices are crossed over, maybe I should just be looking for bullish trades. That's all we're saying here. Again, there's nothing magical about the crossover. It is a lagging indication. Notice the wording. It's not a signal. It's not a magic bullet, as I keep saying. It's an indication. The short-term average, the 50-period moving average, is going up, and it's now above the 200-period moving average. That's all it is. It's an average of price, and it allows us this lens that I'm talking to. So when we've got that, we can say, you know what, maybe I should be bullish, and I should only be looking for bullish trades when that bullish state is happening. Now, this is the part that I mentioned earlier. When I was jokingly saying that the BTFT, I don't think it means BTFT, buy the dip, what you think it means. So what we need to know is a trend. What is the trend before we can identify a dip? So now that we've got our mechanical trend in place, let me just clear the chart up a little bit. Now we've got our mechanical trend in place. I can start to say, okay, well, at that point over here, the trend is up. And now I know that, I can start saying that any downward movements can be considered a dip. Now, to further filter, I don't want to just buy any red day. I don't want to buy any down day. I don't know how long the retracement is going to continue. Like, for example, right now, we can see that for pretty much all of this year, the dip has been in effect. It's not really trending again, and the average prices have crossed over. What was it? Last month sometime. So the average price is suggesting a bearish mechanical direction, and price is undetermined. So for all of this year on this chart, it's made sense to not trade. That's an important thing to know. So imagine if you're trying to either go long or short, for that matter, right now, or this year on the S&P futures. If you're trying to trade the S&P futures, then it doesn't make sense to you because there's no clear indication of direction. So what I further want to do then, coming back to this part of the chart over on the left, I want to identify the mechanical direction. When has that occurred? Okay, so over here, I'm going to be looking for bullish trades. I'm then going to wait 20 days to make sure that I avoid the false crossovers, the false starts. It does help with the whipsaws in the indication. Again, note the wording. It's not a signal. It's just an indication that, you know what, it's bullish. I'm going to wait 20 days because there's a lagging indication. Maybe there's a few false starts. And at that point, I'm looking for price to be moving favorably, bullish in this case. And then when it comes back and again, although I've got three moving averages, for simplicity, I'm just going to focus on the 50-period moving average. There's the 200, the 50. So what I'm going to say is that when price comes back to the 50-period moving average and then goes back above it, I'm going to call that my buyable dip. So I've identified a dip in the context of a trend that I consider buyable. When it comes below, ding, 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 I'm interested. When it goes back above, ding, 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 the trade's going on. So that's the condition. So buyable dips, again, I'm just going to focus on, I can do the same thing with the 20-period moving average as well, but I'm, again, just for simplicity, because the chart will get really messy otherwise, I'm just going to look at all the times that prices come back to the 50-period moving average. Again, there's 2 or 3 there, so I'll just mark it off with a square. There's one there, there's one there. And again, I'm just going to mark that off with a square there, okay, because it's come back. Okay. So what we can identify is we get to filter out all the noise by using the average. In this case, the 50-period and the 200-period moving average. We've got our mechanical direction. We've got our buyable dip in the context of a trend. And then we've got a condition that says when it goes back above, then I'm going to be interested in participating in what could be the next trending movement. So if you notice, we've got the all the times where price has gone back above and stayed above the 2 moving averages. And again, I'm also marking off the times where it would have produced a monetary loss. So you've got 2 out of the several opportunities where that condition, those rules that I've just described to you, of either lost money or make money. And for the eagle-eyed among you, you can see that there's a little bit of there's a blue triangle that has got that, and then there's like some dots, either if it's a positive trade or if it's a negative trade or lost money, essentially. So that's what I've just marked off. So that base set of rules that I've just back of the envelope to you. That's it. That's the big secrets. When it goes above the averages, go long. When it goes below them, take some profit, go to cash, waits. That's it. Mic drop. We can stop the show now, right here. Let me prove it to you. So they're the rules. This is, for the most part, this is what I've been doing all my life, and it's boring. Initially, I did a discretionary version of this, but I've largely traded the same way most of my adult life now. I'm thinking about it. But what I get to do is I get to plug those rules into an algorithm. If this condition happens, then take this action. Those 4 simple rules the coding behind it's a little bit more complex, as you can imagine. But what I get to do is say, you know what, here's the rules. If I just did that and didn't think about the war, if I didn't think about COVID, if I didn't think about Russia, if I didn't think about insert conflicts, Gulf War I, Gulf War II, if I didn't think about non-farm payrolls, the Fed, the quantitative easing bullshit, insert your bullshit reason to be worried about the markets. You take all of that fear out, you put the rules in, and you look back over since 1999, over 20 years, and say, if I'd just done that, when the average prices are pointing upwards and prices above the average prices go long, when it's below them, go short. That's pattern number 2. Don't tell anyone. But if I just did that, then I've got what we commonly term in the industry as a positive expectancy. And legally, I've got to say that past performance is no guarantee of future performance. But at the end of the day, this is how the finance world works. We're looking for a historical, statistical, quantifiable, definable edge. This is what it looks like. This is what it means to have positive expectancy. All I'm trying to figure out is, well, if it's done this over the last 20 years, will it continue to do it in the next 30 days? My average time in trade is about 30 to 45 days. Now, the data can tell me, I can go and have a look at the performance. So my actual trade history reflects the theoretical as well, the historical performance. So I know from thousands of trades of my own trading that it matches up. Again, the coding side of it is a recent thing in the last 2 or 3 years. So I've been able to validate all the rules that I've had and come to you now with absolute confidence to say, it's not just me that makes it work. It's not the thing that I bring to the table, some secret ingredient, because Phil sees the world a little bit differently. And don't forget that crazy thing he's got for flamingos. He clearly sees things differently. So it's not me that brings things special to the table. It's the system, it's the process, it's the rules, it's the algorithm that works. So why don't we do it? What stops you from doing it? What stops you from following a systematic process that finds, filter, and sort stocks and clearly makes money? You've got my strategy. I remind each and every one of you of it every week. Why isn't it working? Why aren't you doing it? You've got to ask yourself that question, because again, if it was easy, everyone would do it. I can quite literally, and I do, and I have done for years, given away the secret sauce. There's the secret sauce, just one of the patterns that I trade. What makes it hard is doing it, having faith in the system. Again, one of the things that we can do now is we can, again, plug those rules into the process, into the software, and say, if I'd done this on this stock or this futures contract, would it have worked? Yes, it would. So I know that this system works on the S&P futures. That's great. That's good to know. Now, let's look at a few stocks. Let's look at an example of a stock that doesn't work with this system, because I want to kind of show you, again, let's look at my usual donkey stock is Pepsi Cola. It's not that it's a bad company. It's not that it is, again, it's a multinational, big mega cap stock. It's got great dividends. It makes a profit. It's a good company. It's probably going to continue to be a good company. But for this style of trading, swing trading, to profit from the ebbs and flows in the stock's price without being glued to the charts, that allows you the time freedom to do other things, the day job, life, enjoying yourself, whilst at the same time getting all the benefits that are promised us from the stock market that Wall Street's supposed to be providing for us. This is not a favorable stock. So this set of rules that I can plug into the software, and most reasonable softwares these days can do something similar. TradeStation's a bit of a beast. I urge everyone to try it. But you can get non-coding tools like TradingView or TrendSpider. You can put the if this, then that, and put more basic versions of what we've coded up here into the system. But anyway, coming back to Pepsi, this is a stock. It's not that it's a bad company. It's not that it's a bad stock. It's just that the price behavior isn't favorable. So I know that I can't trade this stock. It doesn't mean that I can't profit from it. What it means to me when I look at this data or the historical performance over the last 20 years, it suggests to me that while it's a good stock, it's a good company, it just doesn't behave favorably. So if I was going to trade it, I would need to be selective. I've now got to start applying discretion. I've now got to start looking and hunting for opportunities if I wanted to trade this stock. Whereas if I trade, again, going back to the S&P, if I want to trade the S&P, I know that I can trade this chart. Again, we could look at the ETF. There's a comment in the chat about it. What about the ETF? What if we don't want to trade futures? You can trade it via an ETF. Does it work on ETFs? Yes. How do you know? I can plug it into the system and say, if I had applied those rules to the S&P 500 or SPY, the ETF equivalents of the futures markets, would it have yielded a result? Yes. Yes, it would on average. Is it going to work over the next 30, 60, 90 days? Probably. That's the best anyone can say. I don't know what tomorrow's going to happen, but there's a high expectation that it probably will. Now, the way that I like to use this chart is the data. Again, I'm less married to the number, but if this is the S&P, this is the benchmark. This is what the average looks like. It's better than buy and hold, number one. And I get to measure all the other stocks against this performance. But this is a positive expected. It's probably going to continue to be favorable in the future. The point was, it means that I can place the trade without thinking, without discretion. I'm not second guessing myself. I'm not looking for, is there a insert discretionary pattern, a cup and handle, a triangle, a flamingo, a dinosaur? I don't know what they're called these days. I used to trade that way. I knew 34 different name patterns and all their associated rules before I gave up counting them. There could be some sort of fractal patterns, some harmonic fractal structure or whatever. It doesn't matter. I don't need to apply any discretion to this chart. When those conditions are met, the average prices are up and prices above all three move or all the moving averages. And the way that I described earlier, when that happens, go long, you're going to make some money. That's why we're all doing it. That gives me the confidence. It allows me to sleep at night as I'm not second guessing myself. I'm going to step off my soapbox for a moment. Does this make sense, folks? Holler back at me. Pop a comment in the chat box. Does it make sense what we're talking about here? This is what systematic trading looks like. Take the discretion out, put rules in, and see if they're profitable. Awesome, Glenn. Thanks for your comments. Randall, of course. And Steve's popped a few trades in the back of the net yesterday, so well done, Steve. Fabulous. So now that we know the rules, now that we know what we're looking for, I can then go through. I've just done this. It's the only time-consuming thing that I do. I got a list of stocks which I pre-qualified. They've got options, they've got volume, they've got liquidity. I can take, for example, I can take the best 500 stocks with weekly options that have volume, that have liquidity. They've got reasonable bid-ask spreads, and I can go through them one at a time and just plug them through the algo and say, you know what, was this or would this be a good stock? So, for example, ABC. I'm not singing to you, honestly. It's the stock ABC. I can plug this stock into the algo. So this is new to my universe. Again, I reevaluate the stocks that I'm trading every 1 to 2 years. So I haven't done it for a wee while. I've just done it again. I've got the latest version of the algo back from the coder. I'm going to chuck it through the algo is my production line. I'm going to plug the stocks through the algo and say, was this a beneficial stock? Because then the chances are then, if I can figure out my top 25 stocks, the best of the best of the best, and I've got the top 25, the top 50, and the top 100, I've got a universe of stocks. I would start everyone off with the top 25 stocks. That's over here on the left. Take a screenshot, have them with my blessing. These are the best stocks. So when I apply the rules that I've described to you, and only those rules, no discretion, not taking anything fundamental into account, on average, over a long period of time, it's produced results. That means that if I continue to trade this stock for the next 30, 60, 90 days, oops, can't spell numbers, 30, 60, 90 days, then there's a good chance that it will continue to behave favorably for the next short period of time, because that's what a trend is. The stock behaves favorably. That's what I'm looking for. So again, I can look through those stocks. I'm going to focus only on the top 25 stocks, nothing else. That's my universe. So you go through, these are all the best stocks, the best, the best, the best. I'm looking through the research reports, the algorithms, a little bit time consuming. It's worth doing. Again, I do it infrequently, but it means that I can now say, ABC is a good stock. Why? Because it behaves favorably along with a few other metrics that I like to see. So looking at the chart, we've got this lovely rally in an uptrend. Let's get rid of the reports. Got this rally in an uptrend. Wonderful. That's exactly what I'm looking for. I do not buy rallies in an uptrend. It's just gone from down here. It's gone all the way to its target. The algorithm plots the stuff on the chart for me, which is great. What I'm looking for, the secret. What I'm looking for is what? A retracement back to a buyable dip. Absolutely. Well done. I'm looking for a buyable dip. I'm looking for it to come back to the moving average. We don't buy rallies. We're smarter than the idiots who watch the financial TV and run around like headless chickens going, diamond hands, baby. We don't do that. We're smart traders. We're doing the opposite to what everyone else is doing. We're waiting for a retracement, a stock to be at a discount. We've defined what that is. It is when price comes back between the moving averages. When that happens, that is my buyable dip. When it turns back around, it goes back above, I'm going to buy said dip. You find a buyable dip, then buy it when it turns around. It's as simple as that. Patience is the name of the game. This is what makes it hard. This is waiting patiently for the crop to yield. Like we want to be a farmer in this metaphor. We don't want to be hunting. We don't want to be hunting and flicking through chart after chart after chart like a mindless zombie trying to find the next meal. We want to be a farmer. We've got a crop of 25 stocks. That's our crop. And I'm waiting for it to yield. So we need to be patient. Wait for that dips. That's what I'm looking for. So it's not no, it's just not today. Let's take a look at Allstate. And to be fair, I can also use the system that I've described. I've got a traffic light version. I've not talked through it for a while. It's a bit late for me to start doing it right now. I'm just going to go through the stocks and look at some of the new stocks, or my list and look at some of the new. But what I can do is I can do all of that scanning. Is price in a buyable dip on the radar screen? And I can quite literally just click and pick which stocks I need to look at today. So it makes it even quicker. But even if you only have the basic charting, you don't have the extra custom tools here, looking through 25 stocks 2 or 3 times a week, it's not that labor intensive. It's not that time consuming. What's up, kitty cat? I've got my cat joining me today. If you're wondering what the noise is in the background, yes, I know. So we've got Allstate. We've got a buyable dip, just waiting for that to carry on. COP. This is ConocoPhillips. So again, another buyable dip. We've got a lovely trend. The average price has crossed over, got multiple buyable dips, got another buyable dip right here. So I'm waiting for price to advance and move back higher, and then we can start profiting. CVX. What are we looking at? I think we looked at this last week, didn't we? Not last week, the week before. So again, we've got a lovely buyable trend, rally retracements. We've got trending, retracing. So it's back to the 20. So it's waiting for it to turn around. Again, already in this one personally, waiting for it to start moving favorably. HPQ, again, new to my universe that this is being promoted. Again, currently, I can see, again, the algo has fired off a trade, a little bit of common sense. One of my other money-making patterns is to spot consolidations. I spent 12 years trading what essentially is various forms of consolidation. So I'm waiting for a breakout move, essentially there. And the algo doesn't take that into consideration. If you want to just trade through, that's cool. Arcadia. Again, we've got the average prices crossed over. The average prices are bullish there. So there's a little bit of conflict. So although we've got, we could call that a bear flag, there's a little bit of conflict with the application of the rules. So you know what? We let it go. Don't need to worry about it. CLF. This is again Buyable dip. We've got rally retracements. This is again consolidation. That's what the breakout looks like. Now we're back to trending. We've got the breakout rally retracement back to the 20-period moving average again, and you can see it's already starting to take off. So when you've got, again, did it something similar like back here. So you'll see the same thing now that you know the secret, rally retracements. When you've got that framework of either, the 20 and the 50, and optionally you can use the 20-period moving average as well. When you've got that framework to evaluate the charts, evaluate the markets, and you've got a list of stocks that it's proven to work on, then all we're doing is waiting for the opportunity. Again, this is already live for me. LNG, again, this is in a bullish trending state. It's dipping in the context of an uptrend. That's what this traffic light system on the left tells me, bullish resting. But again, you've got the rally retracements. You've got another rally, another small retracement. So just waiting for it to turn back around. I don't know which ones are going to work any more than anyone else. I'm not going to blow wind in anyone's sail. The only thing that I do know is that if I follow my top 25 stocks that have a proven historical expectation to make money, so this is LNG, this is the past 20 years historical performance. On average, over multiple iterations, this should make money. I don't know if it will, so I'm going to trade the top 25 stocks for the next 12 months. And only those top 25 stocks, nothing else. That's my universe. I'm not chasing memes. I'm not diamond handing random weird stocks on Twitter and forums and some, bullshit discretionary reason to look at a stock. These are the best candidates for this style of trading. I'm looking at my top 25. If all 25 set up, I'm going to place 25 trades. If none of them set up, I'm not taking any trades. So what you'll have is you'll have a mix of bullish trades that are active. You'll have a mix of bearish trades that are also active. So this works on the bear side as well. So if we look at something like Ring Central, RNG, Ring Central, you can see that this has, again, a very steady equity curve over a 10-year history in this case. And you've got a lovely sellable rally in a downtrend. Again, just the opposite. Sell the trending rally, sell the rally in a downtrend. So it's a sellable rally in a downtrend. So it's moving down. It's moving favorably. It's making some money. It's just gone through $100. I'm not taking anything into consideration. So what you'll fundamental reports into consideration, the data suggests that this is a favorable stock. Great, I'm going to trade it. I'm not thinking about it. That's what the data is showing me. I'm not second guessing myself. I'm not saying, oh, what's earnings going to do? I don't care. I don't care about who's managing it. I don't care about the directors. I don't care about mismanagements. Again, I'm not an investor. I'm looking to profit from the markets, as you should be too. You should be looking to profit from the markets. And again, one of the reasons for some of the new people, one of the reasons why I'm so on a soapbox about this is I had my ass handed to me most recently. It's happened about 4 times in my career where something weird's happened. And every time it's because I've traded my opinion. The last and most recent time was post-COVID. Nailed it all the way down, made a metric ton of cash on the way down with the stock market. And I started to get cocky and confident. And like most people, I thought there would be a retest of the market low, a double touch, if you like, before what we now know was this monumental, unheard of V-shaped recovery. And I got my ass handed to me because I was stuck in my opinion. I thought there was going to be a retest. I'd just come off the back of some huge gains. My ego was huge, overinflated. I can only say it with hindsight. At the time, I didn't think it was. I thought I was being, well, there we go. I thought I was being there. That's the clue there. I thought. But what I'm trying to do is, like, I'm trying to remove that discretion because it cost me a lot of money, an awful lot of money. It took me about 4 months to back out of my own opinion, to unwind the positions, to back it out, to turn it around, to get over my crisis of confidence. And this is what sent me down this next path of my own trading career. Is it me that's done something wrong? Is it the markets, or is it the strategy? It wasn't the markets. It wasn't the strategy. It most definitely was me, because I thought I was smarter than the system. And again, I'm not ashamed to admit it, because if you can learn from my mistake and avoid that mistake, then that's a great job. Well done, as far as I'm concerned. So hopefully you can see why I'm so strongly, or trying to be very insistent about following the fucking rules, because rules are boring. They make you money, and they've made me more money in the last 12 months, having firmed up the strategy. So one of the things that it allowed me to do was to firm up the strategy, I'm not a coder, so find a programmer to program all these things in, and I've got the right stocks now. Some of them weren't the best candidates, and I've got the right stocks. I've got the more refined, a more robust strategy. It's not my only strategy, but I've got a more robust strategy. And what you'll find is, when you're just focusing on the top 25 stocks, you're going to have a portion of those 25 stocks that are bullish, either bullish active trades, bullish retracing, waiting for them. Some of them are going to be in limbo, like the SPY, S&P 500 is in limbo at the moment. So it's kind of caught between picking a direction. You're also going to have a portion of trades that are bearish, that are in a bearish trending state, like Ring Central. So what you'll have is, out of your top 25 stocks, you may have 7 to 10 of those are bullish, and you may have 7 to 10 of those in a bearish trending state. And there's going to be, let's just say 5, and then mix the numbers up. So you got top 25, 10 bullish, 10 bearish. 5 are going to be neutral, not really doing anything significant. You're not always going to have all 10 bullish, all 10 bearish. You're going to have a mix, and maybe you'll have 5 positions bullish on, 5 positions bearish, give or take. What you'll find is there's often a natural balance in the portfolio that reflects the markets. So you have this automatic portfolio hedge when you start thinking about managing even just a small portfolio like this, top 25 stocks. That's going to give you exposure to bullish movements and bearish movements. And there's going to be some of those trades that are just kind of in limbo, as I mentioned before. And that's kind of the proportion that I've seen. And I've seen this for years. It's not just a recent thing. I've noted it many, many times over the years. And this is one of the kind of the key components for me that allows me to step away from the markets. Thursdays, I'm usually hiking somewhere. I'm going to decide to take a day off, take a week off. The last 6 weeks, I've actually done very little because I've been doing a lot of research. I've not really been pressing the accelerator on my trades. I just get to take the gas off what I'm doing. For the rest of this year, now that my university research, I've got an even bigger group of what I consider to be the best stocks, the top 100 that I mentioned earlier, I'm going to press the accelerator for the rest of the year, because I've got absolute faith and confidence, as I've shown you. Hopefully you should have that right now, because these are the right stocks with the right strategy. And it allows me to step away and not do anything, not worry about a market crash, not worry about what's going on in the world, because you're going to have this natural balance. If the market goes up, the bullish stocks will be bulling. If the market swings down, the bearish stocks are going to be bearing. Just because the S&P right now is suggesting to hold cash and it's not really going anywhere, it doesn't mean I'm not trading. It means that I'm not trading SPY. It's in my universe. I'm not making a measure of what I should do by the markets. There will be some great stocks that perform in a bullish state and a bearish, like Ring Central, very firm trend to the downside, and yet the market, SPY, has done nothing. So there are opportunities everywhere, and if you've got this balance, it won't matter what the market is doing, whether it's booming, busting, crashing up even. I never thought I'd catch myself say that, but we've seen it happen. The market can do anything at once, And all right, fair enough. If you don't catch the bullish trades on the management rule that I teach, the bearish trades will more than take care of themselves. Like for example, right now, if you've got your bearish trade on, and you've got what have we got there? Almost 6, 8, 12. We've got multiple opportunities to get short. The last one was there. You've got 150 down to $100. Would you be happy with a $50 move to the downside? One trade can take care of several underperformers. And note the wording there. I'm not saying losses, I'm not saying losers. I don't want to call them losers because I didn't do anything wrong. How can it be wrong to take a loss? You did everything that we said we were going to do for the trade. It's just yielded a monetary loss. Again, like a farmer, a portion of that crop is not going to yield a great result. Sometimes there's going to be a patch of the crop that just doesn't produce at all. But on balance, the portfolio as a whole, the top 25, over a long period of time, the season will yield a good crop, a good result. And that's what we're looking for, this farming approach. So anyway, when you've got the portfolio style approach, top 25 stocks, that should be manageable for the majority of traders, regardless of your experience, regardless of your capital requirements. You should be able to trade that. So how do you do that? So another kind of piece to the puzzle of this is to use options, stock options specifically. Don't be scared off by them. If they are brand new, and they are for some of you, don't be scared by options. Despite what the financial regulators say and the Wall Street idiots say, they're one of the safer methods to trade compared to stock. If you're a buyer of an option, think of it like a deposit. What's the worst that could happen is you lose your deposits. Whereas the worst thing that could happen with a stock is it gapped. Like Netflix is a great example. NFLX. What if you'd gone long? NFLX. What if you'd gone long? What if you just thought, over here, we're at support, I'm going to buy. I think that's a great reason to do something. Or maybe you're down here, we're in the small consolidation, buy range lows. It's one of the things that I teach. You might be thinking, yeah, that seems like a great idea. Using one of these discretionary patterns and not looking at the trend. But let's just say that you did that there. You've got a huge gap. It's going to go from $500 down to $350. If you've got a stock trade, you're going to take all of that as loss because it's not physically traded there. Same here. If you bought at $350, it's now at $250. You're going to take a huge loss there. No matter, even if you want to only lose, say, at $10, you've got a stop loss. It's super tight. I'm prepared to lose $10 a share, whatever the number is. Your stop loss won't get triggered. It's going to gap. It's infrequent, but when it happens, this is a confidence crusher. This is an account crusher. There's so many reasons why this fails. Now, if I'd placed an option, long or buy a call, the same dollar risk, the worst that could happen is, well, you lose your premium. You lose the option. That's it. There's no extra cost involved if it gaps like this. So options are far less riskier than trading stock when weird shit happens. Under normal circumstances, it's neither here nor there. And the other reason, and the other thing that I would urge you to consider is it's less capital intensive. So if you risk in, say, $500 on a trade, then that's your risk. End of story. There's no margin requirements. So your risk is $500, your cost is $500. It means that you can start to trade more frequently. You can start looking at a portfolio because you've got more capital available. If you've got a small account, look at debit spreads. Instead of trading a single option, look at debit spreads. So you can go all the way down to $30 or $50 risk for small accounts and get your 25 stocks in as a portfolio. So there's no reason not to trade a portfolio style approach, trading one stock at a time and hoping that you're going to get wealthy and create some lasting financial stability and peace and change and all the things that we're looking for is not going to happen overnight if you're trading one at a time. The way that the banks, the institutions, and certainly when I ran my own funds, the way that we made money was on average with multiple occurrences. A portfolio is another way of saying it. And if you're trading one at a time, like my investors would have been like very unhappy with me, because they're not getting the performance. So the way that wealth, like money is made, is with multiple occurrences, consistency, having a strategy, and trading a portfolio as I've described. Use a strategy that obviously works. Use a strategy that you have faith in. Where is my thing? There we go. Let's look at the markets. So use a strategy that you have faith in on a portfolio of stocks that make sense. And if you want to do it on ETFs, like be a little bit more safer, do it on ETFs. There's a list of ETFs right here that this strategy works on. If you want to trade 10 ETFs, 15 ETFs, 20 ETFs, again, I'd go for about 25 stocks or ETFs as a reasonable number that will give you what you want from trading. Because again, there's going to be some trades that just don't make you money, that lose money. And that's fine. That's part and parcel of any business, because trading is like a business, and every business will have some losses, but the winners, the gainers, should significantly outperform the losses by a multiple factor, a huge multiple factor. So it is possible. It can be done. You've got the rules. You've got the strategy. Let's throw on the performance reports. You've got the proof that it worked. You don't have to take my word for it. The rules that I mentioned to you earlier, when the average prices are crossed up, prices above the averages go long. When it comes back below the averages, go to cash, take profits. There's a few other bits and bobs in there. You're obviously getting the back of the envelope version in this free session. But there we go. There's the proof. At its most basic, that's what works. All you've got to do is go and do it. I want you to go and do it. I want you all to make money. Again, I had no one to ask when I started out. So there it is. With my love, with my blessing. Does it work on crypto? Yes, it does. Does it work on futures? Yes, it does. Does it work on stocks? Yes, it does. Put the trade on, run the algo through the instrument that you want to trade and see if it works. If it doesn't work on, for example, Ethereum 4-hour charts, it crushes it. So if you want to trade it on crypto, go for it. I just prefer not to. Again, a lot of what we do as traders is personal preference. I don't want to trade crypto. I've got nothing against it. I just don't want to faff around, open an account, having multiple accounts on multiple exchanges. I just want to, log in, place a trade with options. It's capital efficient. That's how I want to trade. I prefer it that way. It allows me that peace of mind that I mentioned earlier. So the only reason why I don't do it is because the way that I want to trade, the style of trading that I want to trade, the relaxed, carefree approach with using options is not yet available in the way that I like to trade with some of the other instruments like crypto, for example. Will it work in European stocks? Yes, it will. So same answer. Run the algo through run the rules through the software that you're using. If it's TradeStation, use it through something like TrendSpider. You can plug something a little bit more basic, a little bit more simplified into it. There's lots of if this, then that tools out there. So yeah, just run your trade idea through the thing that you want to do, validate that it works, and then go and place the trade. So yeah, there we go. Right, I'm wrapping up a little bit early there. Let me have there's one more question. If the algo enters a trade when the price goes back above the 50, when does it exit the trade? To be fair, Rodrigo, I think I've answered that question already. Goes up, take profits at predetermined targets. When it comes back below the moving averages, close it for either a profit or a break-even trade. There's a little bit more to it. Again, as you can appreciate, it's a free open house session. You've got everything you need to make it work. I can't tell you what targets to choose. If you want to choose a target rather than wait for the trade to do, look at what the stock's done last time. I mean, the S&P looks like it moves in certain amounts. Just eyeball this. I mean, just look at the scale. It looks like it's been moving for most of last year in $20 to $30 clips. Do a multiple of that. It's going to move $20 to $30. So the next time it pushes, it's going to do $20 to $30. So when it goes back above and the average price is crossed up, maybe it gets to $480. That'll be the next push. I personally want bigger moves. I'm looking to try and capture that in one trade. That's what I'm trying to do with my own trading. So you can tweak the dial for what you want. And some of my traders want the smaller targets. They want the quicker payouts. So they've got smaller targets. I want bigger targets. That's what I'm doing. That's what my algo does. And because I want less trading activity so that I can be up a mountain on Thursdays. I can go to zoos, I can go flamingo spotting. I can take a few days off and not have to worry about it because I don't need to be at the desk with the way that I want to trade. Does that make sense? Okay, got it. You've got it. You understand why I'm doing that now. So if you want smaller targets, the trade-off is you've got to be at the computer. You've got to be sat there managing the trade or waiting to be managed. You can't be far away. I don't want to do that. I want to be able to unplug, take a few days off, fuck off somewhere and enjoy myself, and then come back and take profits. I can check it 2-3 days a week. Arguably, you can check this once a week with the way that I've described it. Like everyone else, I'm human. I'm going to check in 2-3 times a week, but you can get away with doing it once a week if you want to be super passive and have bigger targets, have a longer time horizon, and make oodles of cash. Just waiting for those moves to happen again. You want to be farmers. We want to farm a profit. We don't want to hunt. I don't want to be flicking through charts. I don't want to be glued to the screen. As soon as I finished here, I'm going to turn the computer off. I'm going to meet the wife. We're going out. We've got a weekend of activities planned. That's what I want to do. Does that make sense? Can everyone get on board with that, with the way that I'm approaching this? I don't want to be sat at the computer looking at charts. It's a waste of time. It's mental masturbation. There is nothing worse than watching the chart go up and down, up and down, up and down. What am I doing looking at the chart here? It doesn't make any sense. Put the trade on. The data says to put the trade on. It says put your stop here, your target there, and walk away. That's it. That's all you got to do. Go and do it. Right. Let's think about landing the plane. What was your biggest takeaway today, folks? What was your biggest takeaway? Other than Phil's on a soapbox again. Other than he's on a soapbox. What was your biggest takeaway? Did you learn something? Did you see the markets in a different view, in a different light? Has the penny dropped with what I think Rodrigo's got it, like when not to sit at the charts, flicking through chart after chart after charts. No one wants to be a zombie. So trading the plan does not produce losses on balance. Just do it. I like it. Awesome, Zeke. I think that's an interesting point, Zeke. I mean, I've got to admit, the root cause of that, trading the plan does not produce losses on balance. It might produce individual trades as a loss. You're absolutely right. But I think where most people focus on is they don't want to take one trade as a loss. And if you, so let's digest that, because I did that for years. I was just nervous as everyone else before I was able to validate trades and ideas. Root cause of being worried about one trade is probably position size. If you think backwards about why you're having an emotional reaction, I'm worried about this trade. I'm worried about, I don't want to lose more money on this trade. I've seen grown-ass millionaires cry over another $50 loss because it was another $50 loss that was pissed because they couldn't make it work. You've got a system that works. So there's no reason for you, firstly, not to have faith and confidence in it. And if you want to go faster, send me a message. All my traders get access to the same tools that I've shown you here today. But it's usually that fear, the hope, the greed, like, is this going to work? You're trading one at a time. You've had a bad run while you've been learning whatever it is you've been teaching yourself. You've been back of the envelope in it and DIYing it for years, and you're making mistakes and errors and pressing the wrong button in learning software. And oh shit, I've blown another account up. That's ever present at the back of your minds. And you don't even know that if what you're learning works. There's no excuse today. I mean, with technology that you got, you can plug whatever your trading idea is into an algorithm. If this condition happens, then take that action. You can validate. Again, I'm thinking of TrendSpider. You don't have to be a programmer to plug something basic into TrendSpider. I'm not affiliated with them. I was just looking at it over the weekends. But you can plug those things into very simple and just validate a trade idea. I use TradeStation. That's what I use. where you can get quite granular with the rules that you're using. Now, I'm not a programmer. I hired one. I've spent many thousands of dollars refining not just that one, but several strategies. I'm working on another one with them later. I'm actually working with them on another one. I'm sending them something later today. So hopefully I'll have some first version of it over the weekend. But it's that fear of, will it work? And then the next kind of thing that would cause you to be worried about the one trade is your position size is too big. So if you think about what we've been talking about today, have a portfolio, you trade small, trade frequency with a proven strategy. A lot of those fears about, will this work, go away, especially when you trade super small. Again, I'm an advocate of trading really small and trade frequently with a frequency that the strategy sets up. So when you get all of that in place, a lot of those fears disappear. So that's a good answer with multiple facets to it, Zeke. So well done. Rajesh, trade the portfolio. Yeah, it's the secret is, well, there's not necessarily one secret. It's like components, isn't it? So it's, as we just said there, have a strategy, number one, trade a portfolio, small portfolio, 10, 15, I suggest 25 stocks. That's more than enough for everyone. And trade small, but trade with the frequency that the strategy sets up on only those 25 stocks. And you'll get consistency, because those kind of 3 or 4 ingredients make it all. They're the glue that makes it work. It's not the strategy on its own. It's not the one stock on its own. It's not trading an option on its own, or trading. It's several things just make it work. And that combined together, you've got multiple facets to an edge that makes the strategy engine work. Awesome. Good takeaway, right, Rajesh. And Steve, where are we? One last one. Any Columbo comments? Program, Steve. Awesome. This program's not hard to do. It's just hard to have the discipline to follow the system. It's absolutely right. That's the hardest part. I never, 28 years later, I never thought I'd be saying it's all about mindset. I promise you that's as close as I'm going to get to. But it's true. I mean, the hard part with anything is having the motivation to do it. And it's not just trading that's true with. It's anything that's worth doing. Having a regular fitness routine, eating healthy, not necessarily dieting, but eating healthily, cooking fresh, doing things, self-motivation. It's hard work, self-motivating, and trading kind of falls into that category because there's a lot of instantaneous feedback, as we alluded to with the fear, the hope, the greed. You're learning something new, you're learning software. It's frustrating. What if you're learning the wrong thing? What if you're learning the right thing at the wrong time? That can be just as bad as well sometimes. So the early part of trading, I've never shied away from saying it. It is a steep learning curve. So that's a really important thing. It's not that it's difficult. I mean, I've done this with a few people recently. I've literally 45 minutes. Here's the rules. I mean, you've got the back of the envelope version. I went through, it takes 45 minutes because I timed it to explain step by step by step by step with absolute precision. Here's the stocks. This is the entry. This is the stop loss. This is the targets. This is the trade management. That's the rules. It takes 45 minutes. Just like learning golf. If you learn the rules, you can sit down and probably learn the rules of the golf, rules of the golf. You can tell I don't play. The rules of golf in 20 minutes. Here's the book of golf. Here's the rules that you need to. There's the rules. You know the rules. It takes a little bit of practice to get proficient. That's all you need to be in trading, proficient. It's all you need to do in the game of golf to enjoy it. Is just to be passable at it. But it takes a little bit of practice with all the things that you've just learned to become proficient. The same with driving. Driving's not difficult. But when you first learn, oh my God, I remember, I'm sure we've all got our nightmare stories with driving. It's difficult because it's new. You've never done it before. I'm turning the indicator, the windscreen wipers have suddenly gone on. Oh my, and if you're learning stick shift, if you're I'm trying to talk American there, but if you're stick shift, you've got it like mirror signal maneuver, clutch, oh bugger, clutch is falling out the back because I forgot to press the lever. It's the same thing, but now you probably don't even think about the act of driving from A to B. It's unconscious competence because you've been doing it for so long. But when you first learn something, anything, driving, musical instruments, sports, there's a learning curve. The theory, super easy to pick up. 45 minutes, I can teach you exactly what to do, when to do it, why to do it, and what to do it on. Then there's going to be a learning curve for you to go and do it. It takes a little bit of practice, but then once you've got it, pop, you've just got to keep doing it then. And that's what will make you money. So that's a really interesting point, Steve. Thanks for pointing that out. Right, folks, I think I've finished talking. So for those of you who know what's coming next, but let's dock the boat. Let's land this plane. Let's charge the Tesla. Before we do go, let me just offer my heartfelt thanks to each and every one of you. Adrian, Anthony, Bowell, Brett, Chandy, Fitz, Ian, Perry, Raj, Randall, you're not my friend, Rodrigo, Steve, Tom. Hopefully you enjoyed the session, Tom. Vito, Wallace, Zach, and Zeke. We could all be doing something else with our time. I don't take it for granted. Time is the most precious thing. I said it right at the beginning of the show today. Absolutely, Perry, time for ice cream. But it is the most precious thing to all of us. We all have exactly the same time. I want to spend as little time as possible trading. I want to be more time outside doing stuff and enjoying my life. We've all had a harsh reality check in the last couple of years, that life is short and precious. I had mine back in 2001. I was diagnosed with Crohn's disease. I had a priest stand over me and offer me the last rites. So I know what it's like, and that influences the way that I approach things. I want to enjoy my life. So I just want to thank you once again for deciding to spend a little over an hour with me here today. Hopefully we can do it all again next week if you've enjoyed it. So yeah, once again, thank you very much. If you have got any value and appreciation, the only thing that I would ask you to do is to share it with someone else that may need it or need to hear what we've got to say. And lastly, just take action. Put into practice what you've learned today, and we'll all be very happy and making money. If you want to get there faster, you can work with me. Just go to my main website. If you go to productionlinetrading.com, that will redirect you to my website. Otherwise, you can just go to any of the emails that you receive from me and click on any of the links, and that will take you there to some more information. I have a group program that I have. Wrong slide, Phil. I've got a group accelerator. I work occasionally one-on-one, as I mentioned earlier, very infrequently at the moment, as I value my time quite a lot. So I'm not shy about charging a lot of money if you want my time. But nonetheless, the group program is there if you want to get the fastest path to success. That's the hard pitch, folks. But anyway, which one should we use? Let's land the plane. Always remember to practice safe trading, as we've described today. Use a system, trade small, trade frequently, and trade with a plan, trade with a plan, trade with a plan. There's 5 rules there. 3 of them are exactly the same. Use a plan. Rules, as we said, they're pretty dull, they're pretty boring, but they make us a lot of cash. So with that said, folks, I'm going to sign off. The Flamingo Phil will be back at the same time next week. Make sure that you do something fun. Make sure you enjoy yourself. Otherwise, what's the point of doing all of this? My future, as Perry suggested, will involve ice cream. Hopefully yours will too. Have an awesome weekend, and I'll speak to you all very, very soon. Ta-ta and toodle-oo for now. Oh, thank you very much for your kind words, Tom. I'm glad you enjoyed it. Anthony.